Actually, I did not know that I was getting into the crypto industry when I joined Circle. People were amazed that projects were able to raise $40 million on a 20-page PDF. What we saw is that proof of stake made a lot of sense. I think like their mention of staking and transition dates as far back as to like 2015 probably. We felt that this was where the industry was going. We saw that there was a gap in staking services. The interesting thing with ETP providers, they really open up the market to a whole new range of customers that like traditionally would only invest through the bank. The Bitcoin staking ecosystem is really in its early stages. On ETH, there is like no instant staking. So that's why we've built the Tokenized Validator product. It's a way to represent a staked Ethereum validator with an NFT. Well, like we don't wait for regulatory clarity. Like the products that we launch, like we make sure they will comply with future regulations. We're seeing like all the excitement around stablecoin companies.
Do you think that this like stablecoin reward business could be bigger than your current staking business?
Yeah, absolutely. Stablecoins are a massive market. Real world assets are definitely something that we're looking at closely. The vision for Kiln is really like to be a savings account for the world.
Welcome to the Onchain Culture Podcast, where we explore the transformative power of blockchain technology and its potential to reshape industries. In this episode, we had a fascinating conversation with Thomas, the CEO of Kiln, a company that is leading the way in staking services and institutional DeFi solution. We explored Kiln's journey from identifying the early opportunity in staking before proof of stake was even a thing, to becoming a trusted partner for fintechs, investment firms, and enterprises. We discussed their innovative approach, the challenges of institutional adoption, and something like the future opportunities for Bitcoin staking. But Max, who should tune in and what can they learn from Kiln?
I think this conversation is interesting both for institutional investors that want to earn rewards on their digital assets, but also for consumer-facing businesses that want to offer their clients and customers the opportunity to earn yield on crypto assets. Because this is what Kiln has been building out over the last years, both the platform to allocate capital and earn yield, but also a product that can serve as a white label solution for their own businesses. So I think what you can take away from this conversation is both an overview over how the staking market has evolved, how they're also thinking about now tapping into a broader DeFi opportunity. And there's a short hint from my side. Thomas is quite bullish about the prospect of stablecoin rewards to at some point be bigger than staking rewards. And obviously we also touched upon like their collaboration with VanEck for their recent Solana staking ETN, but also going beyond that and talking about the frontiers of innovation, as you mentioned, restaking, Bitcoin staking. So it's really interesting because at the end, Kiln is building for a future where people can earn rewards on all kinds of different stuff, be it crypto native assets or real world assets. And to get a little bit behind the scenes was extremely interesting.
100% agree to that. And that's why I'm very glad to have Kiln as part of the Digital Asset Season, Europe's largest educational campaign on digital assets. For those who are tuning in for the very first time and are not aware what we're doing here, the Digital Asset Season is a 10-week-long educational campaign focused on the most important verticals of the digital asset industry, starting from physical events to digital events, media formats, deep dives, and podcasts like these ones. Did I forget anything, or can we jump right into the episode?
Let's kick it off.
Then see you on the other side. Quick disclaimer before we get started. The content of this podcast is for informational and educational purposes only. It is not a recommendation to buy or sell any financial instruments, securities, or cryptocurrencies. All information is provided without warranty, and the views expressed by the hosts or guests are strictly their own opinion, not financial or investment advice. Please note that we or our guests may hold positions in the financial instruments or cryptocurrencies discussed. And now, enjoy the podcast. A wonderful GM. I'm very looking forward to this episode, as we have Thomas here from Kiln. And for everyone who listened or watched the recent episodes, I like to start with an icebreaker questions, as I prefer this more than doing the usual introduction. And I have a very special one for you, Thomas. So you graduated from university and you got straight into the crypto world. first leading Circle's operations in France, which is a big step after university, and then later becoming the COO at Kiln. Have you ever considered transitioning to a more traditional way than the crypto industry, or what was the path, or why did you choose this path to go into crypto immediately?
It's a great question. Actually, I did not know that I was getting into the crypto industry when I joined Circle. I joined Circle. Yeah.
Okay.
I know it's pretty funny to think about it this way, but when I joined Circle in 2017, they were really focused on Circle Pay, which was a P2P payments app, but really just fiat, right? So you were able to send Euro, USD, GBP between friends and family. And so my job was to come in and make this application popular in France. So it was really B2C consumer marketing activities. And so I didn't think about crypto much. This was on my radar. But when I joined Circle, I noticed a few blog posts about crypto at Circle. And when I joined, I really discovered how deep the rabbit hole went. People were really fascinated by the protocols and tokens and the white papers that were coming out. So I joined in summer of 2017 during the ICO summer craze. So, and I had really no primitives that I could compare this with. People were amazed that projects were able to raise $40 million on a 20-page PDF, which for me meant nothing at the time. I did not know how large or small these amounts were. I did not know how you would raise $40 million anyway. But yeah, it was just very interesting to see. And then, it was the opportunity to deep dive into the white papers of Bitcoin, Ethereum, look at a few projects, start learning about layer twos. Back then people were chatting about side channels. It was also a much simpler space to discover back then. So also left the time to think about the philosophical principles behind decentralization. Well, now a lot of people who get into crypto, because there are so many products, so many trends, it's easy to get sidetracked and just starting with maybe something that's only 2% of the crypto space. Back then it was really simple to discover. So yeah, that's actually how I ended up in crypto.
So was the intellectual angle of, or the topic of decentralization, the corner that you jumped into the crypto scene? Because everybody, I think, has their own angle how they approach this industry. Would the Bitcoiners come more from the economics perspective, then for Ethereum folks from 2014 to 2019, it's really about building a more decentralized Web3. And then there's also the Web2 crowd that ended with the NFT era that are more enthusiastic about new applications being built. So where do you fit in and do it into these different camps?
I'd say definitely more on the economics side of things and how you would structure organizations. I was reading lots of blog posts from Nick Szabo back then. And yeah, there's one which left a mark on me. It's called Money and Social Scalability. And it's he was talking about how people routinely enter contracts with one another, but always it assumes that you need to have trust between these people. And so most of the time trust is the domain of governments and centralized third parties. And so that only enables people to conduct a lot of activities within small circles. So you are able to conduct a lot of activity within a company because there is a construct around it, which is your employment contract and the company, which means that every time you help someone out or every time you request for help, you don't have to sign a contract and there is no monetary payment. So it's you can have a high bandwidth stream between two individuals in a company, and then it scales to a lesser extent to a city, and then to a lesser extent to a country. And basically, his blog article was about how cryptocurrencies and blockchains would enable this to scale to a much larger size of people interacting with one another without having to trust one another.
And now this is, I think, a very good question because I'm really interested in that. So you joined Kiln in 2022, 2020, and back then staking was still quite under the radar. So Ethereum hadn't even transitioned to proof of stake yet. And looking into today, the market has absolutely exploded, with Ethereum and Solana alone securing over 200 billion in staked assets. And I just love to understand, when you started, what did you see in that? What did you see in staking, and what made you believe in its potential? And maybe how has your perspective evolved as the market also has grown?
Yeah, I mean, what we saw is that we just thought that proof of stake made a lot of sense as a consensus mechanism. We saw that Ethereum and the Ethereum community always wanted to transition to staking. I think like their mention of staking and transition dates as far back as to like 2015 probably on the Ethereum blog posts. And so we felt that this was where the industry was going. There was like also really no space for us in mining, right? Because it's such a capex intensive activity that we wouldn't have been able to be part of it. And we believe strongly that in the beginning of an industry, to the extent that 2020 was still the beginning of crypto, it's always interesting to build the infrastructure for this industry, because you're going to be agnostic to the use cases which are going to take hold and succeed with consumers and businesses and institutions. So we really wanted to make a dent on staking. And so what we saw is like, we saw that we really like pictured the blockchain infrastructure market in two ways. Like the first one was providing nodes and developer services for people building dApps. And the second one was staking. And we saw that there was a gap in staking services for the enterprise market, because like there were lots of companies providing validation nodes. This was like super easy to find like another like Ethereum node, but then what was lacking was really the middle layer with the data, the reporting, the commission management that is necessary for crypto companies to integrate staking services into their offering. So we decided to really focus on this, on making it super easy for crypto companies to integrate staking into their offering. And so, yeah, that's how we got started with staking. And as time went on, we expanded our mission to now like aiming to democratize value creation in digital assets. So that encompasses staking, but also DeFi. And the goal is to make it accessible to billions of users directly through Kiln, but also through our partners, which are wallets, custodians, exchanges, ETP issuers. So yeah, that's how we got from what we saw in 2020 to what Kiln is today.
What I find super interesting is also the evolution of the market and the current market structure in staking. So on the one hand, you have like big sexes that have build up their own like internal staking operations and offer staking services to their users. Then you have more from the DeFi native crowd, liquid staking protocols, most prominently Lido. And then you have this, as you call it yourself, like this middle layer that provides these services like as a white label solution also to enterprises and wallets and brokers, banks, and so on, where you position yourself. How do you think about this market structure or this current market landscape and the different parties involved? Could you share your current assessment?
Yeah, definitely. So in terms of companies and entities using staking services, there are a few groups. You have like the consumer-facing businesses like fintechs, wallets, exchanges, through which you can access like staking rewards or DeFi rewards. And the goal is like to have a super convenient, super easy user experience for retail people, but also for businesses. So that's one big chunk of the market. Then we are increasingly seeing the involvement of investment firms that will just invest assets directly and then they seek to earn rewards on their assets. And then the third piece of the market, which is more recent, but is like really moving large sums of money, are ETP providers. And so the interesting thing with ETP providers, they really open up the market to a whole new range of customers that like traditionally would only invest through their bank, through their asset manager, private bank. And so like they naturally like wouldn't necessarily open directly an account with Coinbase or with other platforms, but they want to have something that's packaged in terms of it's like it has an investment documentation, something that they can buy with their bank. So that's how we see the market evolving. And then in terms of the wider market structure for staking, we have seen like a lot of validation companies which stand more on the technical side of things, which are able to operate validation nodes really well, but few have been able to make the leap to selling to crypto businesses and then selling to financial institutions, because then it's a whole different game in terms of getting your operations at a high level. So like businesses will be able to interact and like make deals with you. Like scaling the infrastructure to the point where you are able to deal with billions and billions of stakes is also a challenge. And so we have seen like companies quite early in the space, like not really able to make that shift.
It's also interesting because crypto in general is really all about network effects. And I think the same is also true for staking services, where you have like huge economies of scale. And you can go the route and put up your own distribution, like going the Sex way. And so, you your own user and you just like sell the service to them. Or you could build up your white label solution and sell it to other like market participants who have distributions themselves. You mentioned ETP providers, brokers, wallets, and so on. And if you think about this challenge now to gain their trust and to secure these partnerships, what would you describe as your recipe of success? So you mentioned the difficulties, the struggles to make sales, right, to earn their trust. What really differentiates you from other providers in this market? And so what is your like winning strategy here?
I'd say it's a few things. Like first, I think having the largest product range in staking is really a differentiator, because the idea is to be like the one-stop shop for companies and financial institutions looking to launch their staking offering. So we have like fully automated validators, a one-click staking dashboard from which you can get your reporting, so you make your finance and accounting teams happy. We have a like staking SDK, so it's super easy to integrate staking features into your products. And we've seen that customers, they want both staking rewards and DeFi rewards. So recently we launched a new product called Kiln DeFi to make it easy for wallets to integrate DeFi protocols. Having a large product range is definitely a differentiator. Then there is this element that I mentioned right before, which is you have to understand the constraints of your customers and what they're looking for in a company for them to be ready to deal with that company. And so it includes being non-custodial, which really like removes a lot of the risk away. Having this SOC 2 Type 2 certification, which is an IT security certification, which like audits of the good quality of how you conduct your operations. We have industry-leading SLAs, so we commit to a given level of performance on the 45 plus protocols that we support on the staking side of things. And just like a strong focus on security and having all the smart contracts audited, and we are very transparent about this. We have many blog posts about how we manage our validators, how we do monitoring. So we also like help the industry move forward on these topics. Like for instance, some of these have been published in partnership with the Ethereum Foundation. So I think it's also very important to be in touch with the wider community, share best practices when we believe that we have contributed something that was new to the space. And like to be able to do this, and I think that's like another piece of the like secret recipes. Like you really need extremely talented people, and that's in every area of the company, be it the go-to-market, engineering smart contract, other critical areas. Like you're never going to get there without extremely hard working and smart people. And then I think the last thing is you just need to be tuned in the space, like listening for like new trends, like seeing what's popping up, and then being creative. And so like never take things for granted. Like listen to the needs of the customers. Like we shouldn't be like dismissing stuff, saying, oh, I mean this trend is not going to last. Like we'll just like sit this one out and it's going to be gone in 9 months. And so like we like super fast, I think, to support new products. Like for instance, now we're one of the largest eigenlayer operators. We support like over 15 AVACs. Like we also offering Bitcoin staking through Kiln. So these are like the kind of new trends that we are keen to support.
Yeah, we definitely want to dive deeper into these new frontiers of innovation, like restaking, Bitcoin staking, also what you're doing on the DeFi side. But maybe before we go there, how would you assess the current state of adoption when it comes to institutional staking? So if you look at total like Ethereum stake, we are roughly around 29% of ETH assets being staked. So I guess there's still plenty also both on the retail side, but also institutional side of players who do not stake yet. And what, like from your perspective and also your conversations obviously with them, what are like the biggest obstacles for them to not do it at this point?
Yeah, I'd probably like differentiate between Bitcoin and Ethereum, which are like the largest assets that institutions are looking at. Although like they're also looking at Solana and other major chains such as like Tron and others. But yeah, like there are really distinct trends. For instance, for something like Bitcoin, the thesis for institutions to hold Bitcoin is really clear. It's a digital gold, and so a lot of them have been comfortable doing this. You've seen like the rise of Bitcoin ETF this year, especially in the US. And so the Bitcoin story is like really like taking hold. The thing is, the Bitcoin staking ecosystem is really in its early stages. So there's really like a matter of giving education and guidance to institutions so they can understand how to get started, understand like the differences between the different protocols, the kind of rewards that you get, the risks. And so yeah, like that's the situation for Bitcoin. Like holding Bitcoin is like crystal clear. Staking it requires definitely more education. In contrast to that, for Ethereum, other proof of stake protocols, usually when you hold these cryptocurrencies, like you can easily get comfortable with staking them, because staking is more native to these ecosystems. And you also like have many examples of companies either directly staking their treasuries or offering a staking feature as part of their offering. And so here, the focus is really on educating financial institutions on the risks, how you can get them comfortable to stake, understand what's the risk of being slashed, what visibility you can give to these players about like the performance, how you're able to get them like monitoring capabilities so they can check this themselves. And a big challenge is also like compliance and reporting, so they are able to integrate this with like all their product suite and get this working with their custodian. But yeah, like in both cases, like be it Bitcoin staking, Ethereum staking, or other protocols, there's always an emphasis on security. So usually the way that we deal with this is we'll get like the certifications that are expected of the industry. SOC 2 Type 2 is the one. 1.4 is a really common one. Another common one is ISO 27001, which you'll see a lot of companies get as well. And yeah, getting regular audits of the smart contracts is absolutely key. And then you also need to have like the right entrances in place in case like a slashing event happens. Even though like the space is like has seen that there has been very few slashing events on Ethereum, for instance. So the likelihood of this happening is very low. But still, like, they will expect this kind of reassurance.
So we are still like a little bit stuck in the education phase. So people are still trying to get their head around the risks and of slashing and other security implications that you have to think of. Is this like understood it? Did I understand it correctly that we're still like, or you're still trying to educate institutional investors?
Oh, I think it depends on the jurisdictions and the players, but like there are some who are definitely beyond the education stage. For instance, Kiln is the exclusive partner to VanEck for the new Solana ETN. And so will enable VanEck to stake the Solana that they hold. So yeah, there are definitely players already offering these products live with staking on the market. So I'd say that there's evidence of growing comfort with them. And so it really also like depends on the position of the regulator locally. Some regulators are open to innovation, they're open to dialogue. Some are a bit trickier to deal with. So it really depends. But yeah, and so what we do in these situations is we actually like go hand in hand with our customer or with the prospect, and then we engage with the regulator together to be extremely clear about the benefits of staking, why you would want to do this, actually explaining what the activity is, where the rewards come from, because sometimes there's just like a misconception about how like new coins are created, about the risks that are involved. So yeah, that's like regulatory engagement is extremely important to help this space move forward. And then sometimes that also brings us to creating new products. So for instance, we've developed a product to tokenize ETH validators to meet the liquidity redemption constraint of ETP providers. So for instance, like they have a requirement that they must be able to give liquidity back within 24 hours or 48 hours. And obviously this doesn't match with the exit queue of the Ethereum network, which currently is about 5 days or a week. So we built a way to tokenize validators so you can sell them to another counterparty on an institutional marketplace and get instant liquidity and then be able to meet with these requirements. So yeah, it's really like a mix of making the ETP issuers comfortable with your level of security, level of performance, and their education, then actually doing the same with the regulator. And it's really like a two-way conversation. And then like sometimes new products are required really like to comply. But yeah, like they're definitely ETP issuers such as like VanEck, Onchain, 21 Shares leading the way. There are others which are being very active in Asia as well. So yeah, there's definitely some activity happening in the space.
Can you, since you've already mentioned it, maybe go a little bit deeper into the partnership with VanEck? So maybe tell us how you got in there and maybe go more into detail about the tokenized validator product so the audience can understand the whole process a bit better.
Sure. So maybe I'll start with the tokenized validator product. So the issue is on ETH, there is like no instant staking. You have both like an entry queue and an exit queue. So that means that when you want to stake an amount of ETH, it's not going to be staked as from today. And so the goal for this is because you want to bring stability to the network. Like you don't want your number of validators like to vary from 1 hour to another. And so these entry and exit queues, they can go from a few days like to a few weeks. And the beginning of the network operating on proof of stake, it was even a few months. And so that's great from a technical standpoint, but it's not so great if you want instant liquidity. And the reason why you want instant liquidity, besides the fact that being able to move money around has value, because you could be earning interest rate, like you could be earning rewards somewhere else. So there's really an opportunity cost. But like the reason why there is a lot of value to having instant liquidity on ETH validators is because issuers of exchange trading products they have to be able to give funds back to their investors within a certain time frame. And this time frame can be as short as a day or 2 days. And so if the exit queue of the Ethereum network, which is the amount of time you have to wait before you get your coins back from the network, because they have been staked, if the exit queue is 5 days or 7 days, then the exchange trading product provider is just not meeting with the requirements. And it's just not a product that they can launch, because obviously that's not something that they are going to discover while operating the product. Like they will be extremely clear before launching it about how they will meet with this redemption requirement. So that's why we've built the tokenized validator product. It's a way to represent a staked Ethereum validator with an NFT that you can sell to someone else. And so this other person will be buying it for about like 32 ETH minus a liquidity discount. So you get your ETH back instantly, which you can give back to your end customers. But yeah, it's really like leveraging the concept of NFTs and then bringing that to institutions. But it's like it's totally different type of. Technically it's still an NFT. It's the same ERC standard, the 721. But then it's not really going to trade with like a penguin on it.
And who is buying this NFT? Like I don't I think it's not going to trade on OpenSea. So in order for these ETF managers to go like instantly out and in of these positions, there has to be some kind of a buyer who takes over. So who is going to do that?
Market makers actually. It's really their job, right? Like to price uncertainty around the timeline of the exit queue, to price like the time value of money. What is the value of like 5 days, 7 days? These guys, they know. So most of the time your counterparty is going to be a market maker, which is actually like the same case when you're trading on an exchange, right? Like most of the time, your counterparty is not like me or you, it's a market maker.
It's time for another ad. And this ad is from us. While you're enjoying the conversation, let me give you a quick sneak peek of what's coming up in this exciting 10-week digital asset season. We've already kicked off the season with an exclusive event in Zurich, and you can check out the recap on our socials, but you'll have more opportunity to meet our partners in person or digitally. We're bringing traditional finance together with the on-chain economy in London, February 4th, and in Frankfurt, February 19th. Plus, we've got 2 industry calls where we'll dive deep into the hottest topics in institutional DeFi and digital assets. The next one is on the 28th of January. You can find the link to our event calendar in the show notes. And that's not all. Every week, we'll release a new podcast episode like today's with Kiln, alongside a detailed newsletter dropping every Friday. And now let's get back to the episode.
And does this allow for like a utilization rate of 95%, 100%, or like a staking rate on the assets under management, or do they always to really ensure liquidity, keep a little bit out of stake?
It definitely enables a higher rate of utilization, because if you did not have this in place, you would have to keep more if actually unstaked, which would hurt your rewards. Because let's say the reward rate of the network is 3%, and as you mentioned, like you have to leave 50% out, so 50% unstaked, then actually what you can distribute to investors is only 1.5%. And if someone has a better way to manage liquidity, and they can stake 90%, then their return rate is going to be 2.7%. So it's nearly like 2 times better. So like no one will invest in the former ETP, right? And so like having this kind of product in place is a key competitive advantage for the ETF providers.
Maybe one quick question going back, since we've already talked about regulatory frameworks. In the US, staking has faced some challenges, especially with the SEC raising questions about it. And I can feel that with Trump, these things may change. But in general, regulations around the world are developing differently. And in your view, how are these regulatory changes influencing the future of institutional staking?
Yeah, so regulatory engagement and regulatory frameworks are essential if we want to have wider adoption from institutions of crypto assets and staking these crypto assets. So it's definitely something that we have been actually expecting for a while. And so we actively engaging with regulators across the globe to, as I said earlier, to educate on staking and DeFi, key benefits, key risks, and constraints. As you mentioned, we see different attitudes throughout the world. So the US was historically very tricky to deal with. I'm sure as everyone has seen many stories on Twitter of very large established crypto companies which have tried pretty much honest approach of engaging with the SEC, hoping for some answer for the SEC, just to ignore them and send over a wealth notice, which is a notice that they will do an enforcement action. The tide seems to be turning with the incoming Trump administration. We already obviously there's the nomination of Paul Atkins as the SEC chairman. We're already seeing a change in stance. So we're very hopeful on the US. Our position is that we don't believe that staking should be deemed to be a security. We think it's essential to have open, secure, and eventually, staking is essential to have open, secure, and scalable blockchains and communities. And so that's a point that we'll be pushing further. We've seen great attitude actually in the EU and in Asia from regulators. They're very keen to understand the space. They're very keen to understand the specific products that industry participants are building. In MiCA, which is the EU-wide regulation on crypto, which is set to go live very shortly, it doesn't have specific provisions on staking yet, but it's definitely something that is being discussed with regulators. And then we're seeing in the UK that there will be new laws around staking, but the understanding is that it will not be a collective investment scheme. And so basically our position is that staking is a technical activity. It's not a financial activity. It's not a collective investment. So this is the position that we share with regulators. We have actually published a white paper recently on our blog post. It's about 25 pages. It's an introduction to staking, lists all of the changes, all the big trends that we think regulators should be familiar with. And so definitely there's still a lot of work remaining, and there's still many work streams left to educate regulators on. But we think it's very important to engage with regulators. So the regulation is really education driven. It's enlightened by industry participants.
Yeah, and it really seems like you are engaging with regulators, but you're not waiting for complete regulatory clarity to move the space forward. So that is true for your staking service, but that is also true for the new DeFi stack that you introduced. So you mentioned that on MiCA there are no provisions on staking, but on DeFi neither. But yet you moved into that and also now offer DeFi services to your clients. Can you expand a little bit on that? So what is behind the DeFi stack, and what was the rationale for launching it?
Yeah. And just to come back on the point that you made, we don't wait for regulatory clarity. The products that we launch, we make sure that they will comply with future regulations, right? And we also ready to change the products to comply with it in the future should it be different from what we expected. So we also we're not launching wild products that we think will be unfit in the future. But yeah, like
Sorry, I didn't want to imply that.
No, it's okay. But specifically on Kiln DeFi, it's essentially like doing the same as we've done for staking, which is making it super simple to access, get data about your stakes, about your rewards, or like the commission sharing, and the easy integration within a product. We wanted to do the same with DeFi rewards. And so the goal was really to have a one-click solution with a user-friendly interface. And so what we want in the end is for everyone, and not just DeFi enthusiasts, to be able to confidently swap, bridge, and access these rewards easily, whatever their position, the chain, or the asset that they are in. And so we think that it's becoming increasingly important because there will be an increased amount of monetary flows which will happen on chain. And so we're seeing like all the excitement around stablecoin companies like BVNK, Bridge.xyz, which was acquired by Stripe. Like lots of people share this thesis that money should flow on chain, right? And in 2024, it doesn't make sense that when you want to send a wire to the US, it takes like 2 weeks. Maybe it has bounced back. You'll not really know. So yeah, money should move on chain, and like Kiln DeFi is really like part of the infrastructure to support this, because at some point, like this money is going to be sitting in a wallet, which is going to be on your bank account. And when you have like 300 USDC sitting on your wallet, it should be earning rewards, right? And it should be earning rewards like very simply, something that you should be able to do on your phone on a few clicks, not like at your laptop, stressed out with your like wallet open and confusing, and maybe you'll have some impermanent loss or not. So yeah, the idea is to make it super accessible, super easy to use. And so we've launched Kiln DeFi this summer, in partnership with a few non-custodial wallets that we are working with, because they were not able to monetize DeFi. They had like users going like straight to lending protocols, but it wasn't really moving the needle for these wallets. So yeah, that's why we launched the product. And so it has been adopted with some of our existing customers, such as Crypto.com and Cool Wallet. And yeah, already like signing new clients in the pipeline. So we'll have other launches in the coming month.
So in the backend, you're integrating with Morpho, Aave, or even BlackRock's Biddle, and then you like allocate assets into these products and give back the yield that's generated by lending and borrowing, or how does it work?
Yeah, essentially, like in the background, it's a vault that's invested in these protocols, and then like the rewards flow straight back to the user. So there is no discretionary action or decision taken by Kiln. Everything is set up with the crypto company that we partner with in the beginning, and then like it flows like straight to the specific pool.
Interesting. And if you think like ahead of this and like fast forward 2 to 3 years and in the future, do you think that this like stablecoin reward business could be bigger than your current staking business?
Yeah, absolutely. It's like stablecoins are a massive market. Like currently, it's like $170 billion in stablecoins, but only 4% of stablecoins are earning interest for the holders, while about 50% of proof of stake assets are staked. So yeah, there's like really like a massive opportunity, first for the amount in stablecoins to grow, but also for the amount of stablecoins earning rewards to grow as well. And we can easily see this being integrated in retail products with massive adoption, both in developed countries where people will really care about the efficiency of money, it like earning rewards whenever it can, and people in developed countries where there is like already a strong adoption of mobile wallets, like currently off-chain, such as M-Pesa, but increasingly on-chain, such as like MiniPay and others. So we're very, very excited about stablecoins.
And since you already mentioned like the different perspectives that also institutional players and banks think about when it comes to assessing staking and so on, and also like the general involvement in the crypto space. Security and risk management is always top of mind. You mentioned also that you're setting up vaults together with these partners. Can you dive a little bit deeper into that from like risk underwriting perspective? So how do you think about like smart contract risk and the vault creation?
Yeah. So smart contract risk, we manage by conducting like very thorough audits with leading security firms such as Spearbit. So it's actually like so now the way that tech companies develop software is really continuous, right? Like you always ship new features, you ship updates to your code on a weekly basis, and so the products that you are using every day, like Instagram and Twitter and TikTok, they always get updated. And smart contract development is really like a step back to the previous era of software development, where you have like a V1 and then a V2 and a V3. And like you don't have like a lot of iterations between these, because every time you make a little change, potentially you could be introducing a risk into the product. And so every time, like the best practice in the industry, what we follow is that every time you make a change, even a minimal one, you're getting a new audit to ensure that it hasn't moved anything, that it hasn't opened any potential breach in the product. So yeah, this means being very thorough with hiring smart contract auditing firms. This is something that has to be planned in advance, because the best ones, they're booked like months in advance, right? And you really don't want to not be working with the best ones, because otherwise you're still paying lots of money and you have potential breaches in your product. So that's one key thing. We also have monitoring in place. So there are companies that enable you to check if there is like anything wrong in your smart contract. And so companies such as Hexagate, there are many others. And so we have alerting in place. So it would alert a smart contract team. And I'm speaking about like smart contracts specifically, but we also have the same in place for our software and infrastructure. Like if there is any issue on the staking validation operations, someone will get paged and called during the night or the day, hopefully. And yeah, they'll deploy a fix right away. So it's like being very thorough with the security of the products that we ship. And then once they ship, having like 24/7 monitoring, maintenance in place is very, very important.
In crypto, we can get quite creative when it comes to the creation of new like financial primitives, and also securitization and structurization of new financial products. Now that you mentioned you're operating like staking, DeFi or stablecoin rewards, you mentioned that you're also active on the restaking frontier, diving deep into Bitcoin staking. So basically what you do is really tap into all these different opportunities inside crypto where you can earn rewards, earn interest on your crypto assets. But it's also quite complicated, right? Especially when it comes now to Bitcoin staking and restaking for the end users to think about, okay, in the end, I don't want to have this complexity and manage my own risk. I just want to like have my crypto assets and earn interest on that. How do you envision like the future for that from a UX perspective, like in 2-3 years? Is it that simple that people just have their assets on a wallet and then it's the wallet job together with you to just optimize for the best like interest risk combination, and they don't have to be aware of whether it's been like deployed in restaking, Eigenlayer, or some other protocols? Or how can users think about the future that is lying ahead?
Yeah, I mean, definitely that's the future that we're building. UX that is super simple, like a one-click reward experience. And so currently, like it's really like broken down between like several protocols, several assets. And so it's really on the user to do a lot of the research. But eventually, yeah, I think like a lot of that complexity should be abstracted away. Maybe to set things in context. Like restaking and Bitcoin staking are actually like super similar because they work the same way, right? You as the user, you have the ability to use assets that are already being used for staking in the case of restaking, or Bitcoin. You just have Bitcoin. And then you can use them for additional validation activities without the need for extra capital. And so they will perform like extra security tasks, for instance, on Ethereum on the Eigenlayer network or Symbiotic. And so you will increase the security of other protocols, of other services, while still having your original stake. And it can easily like get super confusing for users, right? Because you have many lending opportunities, you have many rewards opportunities outside of DeFi. So if you have ETH, you could be lending it, you could be staking it. If you're staking it, you can be just like staking it, or you can do like liquid staking, or you can do like liquid staking and DeFi. You could do liquid staking and restaking. And so for like someone like us who's like deep in the ecosystem and very comfortable with it, it's manageable, but it's definitely like not friendly for the next billion users. So yeah, that's why, I mean, we think it's very important to have a product that's tailored for wallets to integrate, for exchanges, for custodians, because ultimately, like, they've only like so much space that they can fit features, options, like potential actions for users to do. And so that's why we seek to like eventually get all of these towards like one-click experience to the fullest extent that's possible. And so like we're already like working with most of these protocols on Eigenlayer. We're one of the largest operators, support like 15 ABSs. On Bitcoin staking, we already working with projects such as Babylon, Core, Botanics, Meso to prepare their integrations with major custodians. It's still really on the early side, but yeah, we think it's important to already like think about having a great UX for these rewards opportunities.
Yeah, speaking of nascent protocols and asset classes, how do you think about incorporating also real-world assets in the future? So obviously with stablecoins, it somehow is already a real-world asset, but again, we're all bullish on this industry and the progress we are going to do in the next years. And I think it's not too far stretched. We can already see like the early innings of tokenized treasuries and so on. Do you also think about expanding into these assets and allow for earning interest, or do you want to rather stick to the crypto native assets?
No, absolutely. Real world assets are definitely something that we're looking at closely. Because, like, the vision for Kiln is really like to be a savings account for the world and to be like an aggregation layer for like all form of on-chain rewards. And so we've started with staking. DeFi was a natural expansion from this, but then it scales like really well to like any form of a reward that you can think about that can be on-chain. Real-world assets are a natural extension as well. That's also why we've looked at DeFi, actually, because we think that it's a natural fit with the growing adoption of stablecoins. And the idea is like always like to be able to reach new customer segments, to like become the infrastructure of choice for all on-chain rewards. So yeah, like reward assets are definitely something that we are closely looking at, because it's just like you were talking about the risk-reward ratio earlier. Currently, like tokenized money market fund on USDC, it's just like it's a great return, right? Like if you can earn like 4 or 5% just by holding USDC, like why wouldn't you do it? It's a pretty good return for most people. Not if you're used to like crazy DeFi strategies and like nothing below 40% ticks your fancy, but it's still like an asset that will get most people interested.
Okay, and as we wrap up this podcast episode, I've already can tell, okay, you're hyped about tokenized assets, but looking into 2025, are there any other exciting things on Kiln's roadmap? Maybe upcoming partnerships, products, milestones that you can share with us? What are you looking into?
Yeah, it's really twofold. it's a mix of international and product expansion, as you would expect from a fast-growing startup. So we'll be focused on expanding Kiln DeFi across like more stablecoins, more DeFi protocols, more wallet integrations. So this will be one big focus, and then the other focus is like the US market and APAC, both of which are extremely promising. I mean, the US, obviously, we discussed it a bit earlier. The change of administration is making people extremely optimistic. The market is opening up very quickly, so this will be a big focus. And then APAC, there is really like strong adoption in like what we're seeing in Hong Kong, in Singapore, but also like in Southeast Asia. We also we have a presence in Japan as well, which is a very exciting market where we see growing adoption of staking as well. And then I'd say like the third focus is working on the ETF market. So we'll focus on like closing key deals that we have currently in the pipeline with top European ETP, ETN providers. And yeah, like we're also very optimistic about potentially like having staking in the ETH ETF that are being looked at in the US. And so, yeah, we're preparing for this opening up as well. So this is what is on the roadmap for Kiln for 2025.
Interesting. Okay. Then we'll see what you guys are going to build in this year or like next year, but this podcast will be out in 2025. So let's pretend it's this year. Last question. If people want to get in touch with you, if people want to learn more about what Kiln is doing, what are the best ways? Is it LinkedIn? Is it X? Is it your website? This is your time to shill your company now.
Yeah, I mean, first, like, have a look on the website, kiln.fi. There are lots of resources first about our products, about the kind of customers that we serve. Do take a read through our blog, and you can take a look at the careers page. We don't have a ton of roles that we're hiring for. So if you think that you do great at Kiln and we don't have necessarily something listed for you, feel free to send a spontaneous application. If you want to be in touch with me specifically, you can find me on X and LinkedIn. I will answer.
Okay, then thank you very much. It was a pleasure talking to you, and I wish you a wonderful rest of today.
Thank you very much for the invitation.
Bye.
Thank you. Bye-bye.